What is the link between quantitative easing and asset inflation? Imagine a central bank decides to buy a huge amount of government bonds to help the economy. This process is called quantitative easing. It is used when lowering interest rates alone isn't enough to boost economic activity. By purchasing bonds, the central bank increases the overall money supply in the economy. This makes borrowing cheaper because long-term interest rates fall. When borrowing costs drop, businesses and individuals are more likely to take out loans and invest. Now, how does this connect to asset prices? When the central bank buys bonds, it pushes their prices up. As bond prices rise, their yields, what investors earn from holding them, go down. Investors seeking higher returns look elsewhere. They might buy stocks, real estate, or corporate bonds instead. This increased demand causes the prices of these assets to go up. This rise in asset prices is called asset inflation. Asset inflation is different from the typical rise in consumer prices. It happens when the prices of financial assets and tangible assets like property increase faster than the prices of everyday goods and services. It mainly reflects more money in the system and higher investor demand, not necessarily higher costs for products like food or clothing. In the context of inflation drivers and manifestations, quantitative easing acts as a catalyst for asset inflation. It expands the money supply and lowers yields, which encourages investors to buy more assets. As asset prices climb, owners of these assets often feel wealthier. This can lead to increased spending, which might influence broader inflation if it continues over time. Governments and central banks use quantitative easing during economic downturns to stimulate activity. But a side effect is that it can cause asset prices to rise sharply. If asset prices go beyond what fundamentals justify, it can create bubbles that might burst later. Central banks keep a close eye on these effects because, while asset inflation can support recovery, excessive rises can threaten financial stability. So, the link between quantitative easing and asset inflation is straightforward. When a central bank injects more money into the economy and lowers interest rates, investors tend to buy more assets. This increased demand pushes asset prices higher, leading to asset inflation. Understanding this connection helps explain how monetary policy influences not just consumer prices, but also the value of investments and property.